Today, we are going to look at the 2025 bullish case for the Toronto real estate market. The question is there light at the actual end of the tunnel? Well, perhaps there just might be. And we're going to take a look at some of the macro and micro trends that could be affecting the Toronto real estate market in 2025 and give us an indication of what's to come. Now, my name is Ralph Fox, and we would like to welcome you to the Toronto Real Estate Podcast. I am the broker of record and co-founder of Fox, Marin Associates. We are a residential real estate brokerage that lives and works in central and downtown Toronto. And today we are so lucky to have our rock star team member, Jerome Werniuk, who's here to talk to us about 2025 and what we could possibly expect or look forward to. Jerome, thank you so much for joining us today.
Appreciate it. Thanks for having me, Ralph.
Awesome. So let's talk a little bit about it. We're going to start from the bigger picture and start to narrow down. You know, you and I have been talking about a lot of things that have been happening globally. Like, what's on your mind right now in terms of some of the discussions that we've had?
Topically, whenever you're watching this, the vice presidential debate in the U.S. was last night, which is a lot more substantive than the presidential debate. Things are escalating in a very scary way right now in the Middle East. And there's been a lot of news recently coming out of China with what they're doing in terms of stimulus. There's a lot of tectonic plates shifting right now that I think we're going to be covering today.
Awesome. And I think one of the things that we're realizing more and more is how global the world actually is and how quickly things can change and how something can happen in one part of the world and very quickly affect the other part of the world. And really one of the things that we're going to narrow down on today is we're going to talk about China. And one of the things that's really been interesting is China has been in trouble for a number of years. They've been experiencing a tremendous amount of deflation. If you look at charts where you compare the Chinese stock market, the Shanghai stock market to the S&P, they basically are a tale of two different stories. Their stock market has been struggling. Of course, we've all heard about the Evergrande and Country Garden bankruptcies, which have really affected the real estate sector there. And unemployment, especially youth unemployment, is now over 20% in China. And it's really relevant because they have that one-child strategy, which was in effect for about 30 years, where all the families that were having kids were basically rewarded for only having males. And so you've got a huge population of unhappy, unemployed males right now in China. And on top of all this, we have the M1 and the M2, which is the money supply in China has been contracting to a very significant extent. And so there's a real weakening right now in China that's been going on for a while. And I think right now things are coming to a head.
Yeah, all of these things are so intertwined. And looking around Toronto pre-construction sales, there's a massive Chinese, Canadian, and Chinese population that are involved in it. And that's kind of like the boots on the ground experience. But all this starts with larger macroeconomic things and the policy changes and items you've outlined. All of those shake out over time. And as global as the world is today, these things directly impact things like Toronto real estate prices.
And what's really interesting is if you look at what's happened in the last few weeks in China, they've basically taken a bazooka of stimulus and just injected it straight into their economy to help rectify some of the issues that their economy is facing. So to go into a few of these things is they've cut bank reserve requirements, meaning the amount of capital that banks have to hold, up by about 142 billion. They've released 142 billion of assets reserves that banks have to hold, which can now go into the economy. They've lowered interest rates by 30 basis points. But to me, what's even more mind-boggling is they've cut existing mortgage rates. So if you have a mortgage rate in China, whether it's a variable or fixed or however they do it there, they've lowered that by 50%. Imagine by 50 basis points. Imagine if that were to happen in Canada, what type of a stimulatory effect that would instantaneously have, not waiting for mortgages to roll over, but instantaneously on the economy. Yeah, also, they took secondary properties because there's a lot of empty buildings right now and empty condos and empty commercial buildings in China, and they've reduced the required down payment from 25% to 15%. And most notably, the central bank has induced really, really, really cheap loans to local governments to buying up unsold properties. And they're covering 100% of that debt. So they're giving cheap loans with 100% loan to value for municipalities to buy up empty buildings that have been sitting as a result of the crashes that we've seen both with Evergrande and Country Garden, to name a few. And then on top of that, they've just been adding liquidity into the market on top of liquidity by having stock swap programs and loans to commercial banks in upwards of about $200 billion worth of US. So we're looking at maybe the effect or compounding effect of $1 trillion or several trillion dollars being unleashed into the Chinese economy. And that's a really important thing to understand because it starts to have ripple effects across the entire globe.
And in I guess if you look back in history, particularly fairly recent history with China, they're not afraid to make big sweeping changes very quickly. That's for sure. Not. We've seen how that played out in 05, 07. How do you think this is actually going to impact this massive stimulus package? Like, why are they doing this right now? And do you think it's going to have an impact on all of the economic troubles they've been having over the last few years?
Well, China has a target of a growth rate of about 5% or of 5%. And it looked like that they were going to miss this target. And they need this growth because their economy, like all the economies globally, are based on debt. And if they don't have continued growth, then the ability to pay debt starts to stagnate. And so they have basically come out and said, we are going to do whatever it takes to hit that 5% target. And so they've indicated that this is literally just the beginning, and they're prepared to put more and more stimulus into the economy to get it to where it needs to be. And that's been the major shift that we've seen since 2008 when we had the global financial crisis, is banks and central banks are becoming very, very, very active in economies to the point of really distorting what's actually happening, and it's causing more and more debt to accumulate, which then in turn causes in a downturn like the one we've seen in China and even in the US to a degree, the need for more and more stimulus.
It does feel more common from a layperson's perspective. It kind of feels like central banks, just reading headlines, are constantly flooring the gas pedal and then pulling the emergency brake. There's not really an in-between. And obviously we've had a global pandemic and all these supply chain issues that came out of it. But where do you think this is actually going to take China, I guess, long term? And I get more specifically with debt cycles, how does the timing play into that within China?
Typically, global debt cycles, there's like this understanding that about 75% of all debt turns over in a range of every 4 to 5, maybe 6 years. And so we have these economic cycles where debt rolls over and global liquidity turns up almost on a pace. You can almost see it on a chart. And we're going to take a look at that in 1 second. But the important thing to understand is that China was waiting for the Fed to drop rates. And everything really, because the US is the reserve currency of the world, everything is really predicated on what the Fed does. And China and Japan were under a lot of duress because they had over tightened and they desperately needed the Fed to make their move. And that's why when Japan, they actually increased slightly, it nearly caused all stock markets across the world to crash. And Japan retracted that and decided to wait for the Fed. And so all eyes have been on the Fed. They just, as everybody knows on this channel, have reduced by about 50 basis points and are signaling that there will be more to come between now and the end of the year. And that in turn has opened the Chinese central bank to open up the floodgates. Now we're going to look at this first chart here, which I'm going to click on. And you're going to see what I'm talking about the 4-year cycle. So you can see the long-term debt cycle in the blue line, the light blue line, and then in the dark blue line, you'll see liquidity following the debt cycle. And if you can look where we are right now, we are slightly coming off the bottom of the long-term debt cycle, and you can start to see global liquidity following. And it's really important to understand that when you're trying to make sense of what's happening in the world and how in turn that could affect markets all over the world, but specifically, we're going to start to narrow down on what that could mean for Toronto. So if you click on this next chart here, what you can actually see is you can see the global liquidity starting to expand. So the trend line is starting to move up. And when that happens, typically when you have the rest of the world easing, what you'll start to see is a rise in hard assets. You'll see real estate start to go up. You'll see US equities start to go up, and commodities will start to go up as well. So it's really important to understand that. And if you look historically, when China has pumped liquidity, there's been a few examples in 2018, 2021, and I believe there was another instance 2014 or 2015. When money moves globally, liquidity pumps, and usually the last three times the S&P, the first time went up 9%, the second time and third time it went up 20%. Real estate hitting 9 to 10% as the liquidity starts to expand. So when there's more money pumping through the system and when money becomes cheap, it looks to invest in hard assets because what happens is the currency starts to become debased. And so people don't want to hold cash in these type of environments, which is really the opposite of the environment we were just in, where everything was tightening and cash had a premium. Now it's flipping, and you're going to start to see a lot of liquidity starting to chase hard assets, and that will have a big impact on real estate here in Toronto.
With all of that being said, Ralph, if you just kind of take the average consumer, the average person that's watching this podcast right now, and take it a little bit from the macro and bring it back to their own lives, how do you think walking around the street for the next year here, going into 2025, what's going to be the outcome, or what do you predict will be the actual impact of all of this fiscal change?
I guess two things I want to talk about in answer to that question. The first, on the bigger picture, is when you start to step back, you realize that the world and the economy flows in cycles, and you start to see that there are patterns. And what I'm trying to point out is there's a pattern when the liquidity expands and when money becomes cheaper, hard assets go up, and it actually starts to become a little bit more predictable once you start to see what's happened in the past and how it's now starting to repeat itself because of just the amount of raw debt that's out there. Central banks continually will need to act in tandem in order to respond. And right now, we're coming out of a situation where we've had high inflation due to excessive monetary spending. Everything has contracted, and in some parts of the world, it is way over contracted. And that's why we're starting to see cracks emerge in the system. And now we're starting to see those plugs starting to happen in places like Japan and China. And so if you can understand that, that might give you a hint. I mean, history doesn't always repeat itself, but it might give you a hint as what's to come. And we'll talk a little bit more about some of the reports that are coming out right now, projections for 2025 in Toronto and Canadian real estate. But I think it's just really important to understand how the bigger picture is going to start to play into the smaller picture. But already it's really interesting because if you look at the surge of capital that's gone into China right now, in a very short period of time, we saw a record 1 trillion Chinese yen traded in 30 minutes on the Chinese stock market, which is just crazy. We've seen stocks up 6% in a day and 18% in 5 days. The Beijing 50 index posted a jump of 15% in 1 day. There are reports of brokerages that are now open 24/7 to accommodate retail traders. And we're seeing brokerages actually starting to crash because of the amount of money that's being pushed and flow through the system. And some observers are starting to say that it's starting to look and feel like 2020. And so if that wave is hitting the shores of China, it's going to start to come around at some point here. And we're starting to see indications of that if you're listening and you're reading between the lines of what the Bank of Canada is saying and what the Fed is saying.
We should see this play out over the next year, you think? And all of this liquidity globally really just start to push hard asset prices up.
Yeah. And the central banks are going to have no choice, and everything is going to flow from there. So I think it's really important to take this into context. But we can talk a little bit about what we're seeing, some of the reports. And it's interesting because we've seen such negativity in the media over the last few years, understandably, about Toronto real estate. We're starting to see a shift in what the media is saying right now, which is really interesting in terms of sentiment. And we're also starting to see some reports come out that are starting to align with what we're starting to see globally from a liquidity standpoint.
Ralph, do you have any examples of this shift in media sentiment and kind of what the public is perceiving around the outlook for Toronto housing or in general the housing market for 2025?
Yeah, for sure. And I know you're super active in the market and talking to clients as well. So I'm sure you have feedback on this. But TD just came out with a report and they talk about economic growth likely to regain traction in 2025. And these factors they're projecting are going to see a solid increase. They're saying 24% in Ontario in sales, which is significant because that will start to put us back aligned with average transactions, which right now are at an all-time low. And they're also talking about powerful gains in Canadian sales and average home prices are going to hit across the first half of 2025, almost like a wave of liquidity and an influx of cheap money coming into the system. What does that say to you, Jerome?
Yeah, I mean, the boots on the ground, speaking to clients, for generally people around the real estate industry, people pretty much feel like the bottom is here, or we've already passed the bottom in a lot of ways. With the overnight rate being cut, raising of the floor or the ceiling for uninsured mortgages, I think those are a lot more tangible, a lot closer to consumers, and they feel that. But those are also symptoms of the grander global economic increase in liquidity that you're referring to. So I think I'm seeing a little more excitement and a little more optimism towards the Toronto real estate market. And it used to be people checking in with me saying, "Are you okay? Is everything all right in the real estate industry?" To now, like, I think there might be some deals around that I could hunt for, because I actually think we're coming to the end of this downturn. And at a certain point, and just like Toronto real estate is known for, overnight, things could dramatically change. We could go from seeing one offer on a decent home in Leslieville to bidding wars all over the place.
Absolutely. And there's another report that came out with Deloitte that is basically mirroring what we talked about earlier about TD and exactly what you're saying right now as well. And the media is starting to pick up on this. So real estate, especially residential real estate, is such an emotional investment that people are making either through utility or for strictly investment purposes. And we've seen it before that when all of a sudden the market shifts, it can shift very quickly up or down. And that's something that we've seen exemplified and magnified since COVID. So it'll be really interesting to see what happens as all of these forces start to play out, because we know interest rates are going to come down a lot. We know we're going to see quantitative easing, and we know that's going to be happening globally. It could have a dramatic impact on 2025 in real estate. And then, of course, when you zoom out and look at the bigger picture, and we've shown various charts, but we're going to pull up this chart here, and you're going to see this was put out by Build. If you can look at 2021, 2022, and 2023 in terms of application submissions, they are declining by extreme. And then if you look at from 2023 to 2024, we'll have gone from 2021 with 2,400 applications to build down to 430 so far this year. So one of the things that's going to be really challenging in the future is the pipeline of new builds, specifically of condominiums. There will be some challenges with inventory that'll have to play itself out over the next year or two. But from an investment standpoint, if you zoom out long term, we're going to be very, very constrained when it comes to inventory, especially in the condo segment. But then again, in the low-rise segment, they're just not building any in central and downtown Toronto. And so how is this going to play out in the backdrop of continued immigration? Even if it's down a little bit, we still have huge numbers of immigration coming here in conjunction with cheap money and liquidity moving through the system. We can't guarantee what will happen in the market in 2025, but it definitely seems like there are a lot of leading indicators and there's a lot of reports that are coming out that may suggest that the market will do a lot better in 2025 than it has in the last 2 years. And I think to people in our industry and to people who own real estate in Toronto who have held on throughout, this has been very welcoming news.
So with all of that said, it feels like, I don't want to call it a perfect storm, but we have both demand and supply side indicators pointing to the fact that we are going to have massively constrained supply, like far worse than we do today a few years from now. And with this massive increase in liquidity globally and eventually here on a local level, these two forces just kind of line up to see real estate prices probably surpassing their 10-year average in terms of increase in average prices. I don't really see any other situation other than some other massive global event that could throw a curveball at this. But it is lining up, it seems like, both on a local and a global perspective, that we are probably going to be seeing a run up at some point in 2025.
Exactly. And the one thing that I will say, and we say it on every single one of these podcasts when we're talking about the market, if you own Toronto real estate, this is completely the antithesis of what most agents will tell you, but hold on to your properties. Why sell at the bottom of the market unless you absolutely have to sell or are making a lifestyle decision that is causing you to transition or the need to transition into something or somewhere else? But if you can hold on, as we've been telling all of our clients, hold on. And this podcast really isn't about trying to create FOMO or trying to do anything other than open people's eyes to see that there's another narrative out there that may tell a different perspective of what is to come in the market than what you're currently hearing or seeing. And we may not be right, and nobody has a crystal ball, but we're trying to do our best to make sense of what could be coming in the future. So thank you so much for tuning in. I always forget to say this, but at the beginning, but I'm remembering now at the end. If you like this content, please be sure to hit that like or subscribe button. And if you have any comments, we'd absolutely love to hear from you. And as long as it's constructive, please be sure to reach out. And if you ever want to talk about the market directly with one of us, myself, Jerome, we are all here to talk to you about what we see happening into the future. Jerome, thank you so much for joining us.
Thanks for having me, Ralph. It was a pleasure.